Hey guys, welcome back. Now, if you have anything to do with investing, you probably keep hearing about the PE ratio. It's referenced everywhere from all the different finance websites, videos, analysts, podcasts. But you might be thinking, what exactly is a PE ratio? What is a good PE ratio? And how do we actually use it to make better investing decisions? Well, the purpose of this video is to demystify and simplify the price to earnings ratio, but more importantly, help make it a usable metric. Essentially, it's a quick way to see whether a company is good value for money. But it's not perfect, as you will soon discover. As it is one of the most popular investing metrics used, I did want to bring it all together in a quick 10-minute video. So by the end of this video, you will know what a PE ratio is, what a trailing PE ratio is, what a forward PE ratio is, what the Shiller PE ratio is, and even more important, how to use it to make you a better investor. As always, if you do find anything in this video useful, be sure to drop a like. That would be much appreciated, as every like does help. Okay, sit back and relax, guys. Here is what you need to know about the PE ratio. Okay, so here is what we've got coming up. We're first going to discuss the problem, so why do we even have the PE ratio? We'll then dig into it and find out exactly what it is. We'll then take a look at some stock analysis of a couple of examples, and then we'll finish with the Shiller PE and some of the cool things we can do with that. First up, the problem. Why do we even have the PE ratio? Well, here's my question to you. Which company is the better investment? Company A and its share price is $1,000, or Company B and the share price is $100. Now, at first glance, you might look and go, well, I can get 10 times the amount of shares from Company B than Company A, so probably Company B. However, there is one major thing missing from this piece. And arguably, what is the most important thing in a business? Profit. How much profit is the business making? So what is the PE ratio? Well, the P stands for the share price and the E stands for earnings per share, or EPS. Now, earnings is just another way of saying profit. So a simpler way to look at this is its price over profit. Price, how much is the company asking you to pay? And the profit, how much profit is there in each individual share? Now you have both sides of the equation. So let's put this in a quick example. We'll use Apple, as it's a company that everybody knows and likes. So last quarter, its share price was $115. Its earning per share was $3.28. So this gave us our first PE ratio, which is 35. So two quick things. How you get the 35 is 35 times $3.28 gives you the share price. And this is why it's known as a multiple. And the second thing is that it's going to take you 35 years to get your money back. So in general, a lower PE is better. Okay, so now we have our metric. We've got it, 35, but what does that mean? A PE ratio by itself doesn't really help you. You now have a metric that you can compare it to other things. And this is where the PE ratio is really usable. It's what do you compare it to? The most obvious thing would be its closest competitor. So let's take a look at Microsoft. Share price was $210. Its earnings per share was $6.20. So this gave a PE of 34. Okay, so now we have a comparison. And we can see, all things being equal, Microsoft does look like the better investment. It's going to take you less time to get your money back. And you can see they're making more profit per share that they're offering to investors. But we can take it a step further. It's even more useful when you can compare it to the sector itself. So these companies fit into the technology sector. So what is the PE of all the companies added together? Well, as it stands, it was 42. So now this changes the context again. Now, Apple and Microsoft look like good value for money in comparison to the technology sector. And the difference between the 34 and 35 is now negligible. Some quick terminology. So you might be hearing about the trailing PE and also the forward PE. It's very simple. The trailing is basically using the data from the previous 12 months. And the forward is projecting what it's going to do over the next 12 months. Now there's pros and cons to each. The trailing is really good because that is what the company actually did. But the downside is that this is in the past. With the forward, it may be more accurate because they're projecting what they're going to do. However, the downside is what a company says it's going to do and what a company actually does can be very different. So let's take a look at Apple. And I'll bring up the PE ratio of the last 12 years. Again, once you see it over a longer time frame, I think it becomes more useful. So you can see 12 years ago, it was breaking that 30 mark. It was then trading in the 10 to 20 range for quite a long time. And it's this last year where the PE ratio has jumped up. But remember, two things make up the PE ratio: the share price and also the profit per share. So I find it quite useful to take a look at all the different metrics. Now you can understand why the PE ratio has jumped, because the earnings per share is pretty steady. It's had a nice good growth rate, so that looks great, but it's the share price that has jumped in the last year. And this is why the PE ratio has also doubled and tripled. So the PE ratio is really good for established companies. Okay, let's take a look at Tesla. And we'll bring up the PE ratio, and you can see not a lot happened for 12 years, and then all of a sudden it's jumped up, and Tesla has a PE ratio of around 800. So what is going on here? Well, let's bring up the stock price and also the earnings per share. So because it's factoring in profit, you can see on the earnings per share, Tesla has been unprofitable for a lot of years, and it's only now breaking into the profit. This is why the PE ratio was 0. And you can see the stock price has jumped up this last year, sending the PE ratio to 800. So why would an investor buy this? They're not going to wait 800 years to get their money back, right? Well, basically, investors are betting that Tesla's profits are going to be increasing considerably over the next few years. And this will drop the PE ratio considerably. So I have found that the PE ratio is not so good for these modern tech companies, where companies get launched on millions and millions of investors' money and they're unprofitable for many, many years. The PE ratio doesn't really help. Next up, the Shiller PE. So what is the Shiller PE? Well, this was created by Robert Shiller of Yale. It's also known as the cyclical adjusted PE, because what he did is he takes a 10-year average of the profits, and this means if there's 1 year that spikes up or drops down, it doesn't mess up the whole chart, as he's taking a bigger average. And he also adjusts it for inflation. So let's look at the PE ratio by sector. And remember, it's always more useful to have a comparison. So right in the middle there is the S&P 500. So we can see right now it's just above 30. And now we can see there may be opportunities in the energy sector, as this has a very low PE relative to the market. And it's saying that real estate is really high. So this chart is the S&P 500 over a much bigger time frame. So this is 120 years. And I do love a nice long-term chart. So you can see here, it really peaked in 1929 before the crash. Also the dot-com in the year 2000. It also shows the all-time historical average is going to be around 17. And the PE right now is around 33. So you can see historically it's traded in this 10 to 20 mark. But more recently, we're now moving into a 20 to 30. But this is a great way to see when the stock market on a whole is either overvalued or undervalued. Compare this to the regular PE, and you can see that there was just a huge spike in 2008. This was the financial crisis, and companies' profits collapsed, which is why there was a big spike. But you can see the Shiller PE becomes much more useful. So this brings it back to the first question. Which is a better investment? We have company A and its share price is $1,000, or company B with its share price of $100. But this time, you know that company A has a PE of 10 and company B has a PE of 40. And you also know the historical average being 17 and the current one is 33. So you can now see that company B with a PE of 40 is way above the historical average. It's a lot higher than the market as a whole in comparison to company A at 10, which is lower than the historical average and a lot lower than the current PE. So even though the share price is more, company A is going to be a better investment. So there you are, guys. I hope this has helped you understand a lot more about the PE ratio. Essentially, people use it to see whether a company is good value for money. And as you saw, it's also a great way to take a look and analyze sectors and also the entire stock market as a whole. And in this case, the Shiller PE does a better job. Just bear in mind that the PE ratio should never be used just by itself, especially nowadays when a lot of companies are launched with millions and millions of dollars of venture capital and they can be unprofitable for years and years and years. It's more useful for established companies. Okay, so just one favor to ask. If you did find anything in this video useful, be sure to drop a like. That would be much appreciated, as every like does help. If you haven't yet subscribed, be sure to click the subscribe button below and join us. I do have some great videos coming up that you don't want to miss. If you still have any questions or comments, just post them below. Okay, cheers guys. Thanks for watching, and I'll see you in the next video. Bye for now.